Up the China action, but Latha, coming to you now on what's happening with the yuan and why the world is rattled. What do you make of the yuan devaluation? What are experts telling you?
Well, it's the official Chinese devaluation that is worrying. That was moving, it moved violently in August, if you remember, and then it was a very slow depreciation, largely 0.1, 0.05 a day. But this week it has been 0.2% in the first 2 or 3 trading days, and today it was 0.56. And the offshore yuan, which is more freely traded than renminbi, is actually widened, moved more far apart. It has depreciated more than the official yuan, and now the depreciation from August levels is as high as 8.5%. Possibly today the Chinese authorities intervened in that market as well. That's the talk. Now, what is worrisome? See, the Chinese yuan was pegged to the dollar. Chances are now, with the dollar appreciating and China not doing as well, they want to unpeg and they want to peg to a basket of currencies. So while against dollar it looks seriously depreciated, they're probably moving in step with a basket of currencies. This is probably a communication problem. The other issue could be they also want the yuan to get more market determined. These explanations will not worry the market. What worries the market is, does the PBOC know something about China which the rest of the world doesn't know? That is what is rattling the market. And I'll tell you why that fear comes, because if you notice, the markets fell about 2 o'clock or 2:30. That is when the FX data from China came out. And that showed that $107 billion of FX reserves had been expended in December. For all of 2015, $512 billion had been expended. The reserves, the famous Chinese reserves of $3.5 trillion, 4 trillion, is now down to 3.33 trillion. So there's not much back. You know, in India, we say that we should have at least 8-month imports, 9-month imports. In China, that comparable figure is actually 3 trillion. So, you know, you're very close to your threshold. There are some people who fear that, therefore, that big Chinese threshold is not really there. And if it really is, you know, 250% of debt to GDP that Chinese banks have, and if much of them are getting rotten, then there is not so much of a backstop that they have in terms of being able to mend various parts of the economy. So China may slow faster and may land harder than what most people thought. It is this that is driving the fear factor. Separately, of course, this is being accompanied by crude falling for its own supply-demand dynamics. The fact that Saudi and Iran are probably trying to make each other poorer and thereby impoverishing anyone who produces oil. So that is a separate fear factor that might render a lot of funds out of pocket and see redemptions. The third factor that we should note in the entire space is that India will be the last one to sink. The rupee actually is usually strong in the Jan-March quarter, because that's when exporters bring back their money. As well, we just had that auction of FII limits. So actually dollars came in today. My guess is that the RBI did not support the rupee today. The rupee supported itself, which means it's really an outstandingly stable currency at this point in time. So while we should worry about stock market reverses, the only point we don't have to worry about, perhaps, or the last thing we should worry about, is the Indian rupee.
All right, Latha, thanks very much. In fact, as Latha was pointing out, the Indian rupee largely stable today, lost 11 paise in trade for a second day in a row after the Chinese central bank devalued the yuan and set its midpoint to its weakest level since March 2011. The currency finally closing at 66.93 to the dollar. If you're rattled by the market,